My name is Jake, welcome to the channel. In today's video, I want to talk about investing with leverage. Now, this is a very controversial topic where I believe everybody has an opinion. Either you're for it or you're against it. I don't think there's a lot of people that sit on the fence where they're kind of just, oh, well, I don't really care, it's not a big deal. I think people are very passionate. And I think a lot of it has to do with their own personal experience or experience from others that have really said, okay, yeah, you have to do this, or no, you have to stay away from this. I want to talk about investing with leverage and what that would look like. And especially with this market pullback, I think some of the numbers are really interesting. The numbers that I'm pulling here and putting together, they really wouldn't have made sense 6 months ago, a year ago, because the numbers are really what define this kind of investing scenario. And I want to be very transparent, full disclaimer, what I'm going to talk about in this video, I am not currently doing today. I'm not investing in this strategy today. This is something that, as I've stayed home these last couple of weeks with this whole virus thing going on, is giving me a lot of time to kind of think about, okay, building wealth, what are some of my options? And I've kind of looked at my own personal situation. But once again, I think it's very important. This is not financial advice. I am not currently doing this, but I think it's incredibly interesting. And if the numbers were to work out, it's something that I would possibly consider. So that is really the full disclaimer there. This is not financial advice. Investing always comes with risk, but I think if you're an investor and really interested in the numbers behind investments, I think you're going to be really interested in this video. So stick around until the end. It's not going to be a long video. I'm going to try to keep it condensed and concise, like a 15-minute video. I don't want to ramble. Let's go ahead and let's dive right into it. When I was thinking about building wealth, I was thinking about how different people in time have done that. Now, you could be an innovator like Bill Gates, start a company, and create an actual product or service. You could be like Elon Musk, an innovator and a complete genius in my opinion, and make money that way. You could be a real estate mogul like Ben Malla. You could leverage the bank's money to build a real estate empire. You could be like Robert Kiyosaki, who the author of Rich Dad, Poor Dad, leveraging the bank's money to build wealth. And so when I was thinking about these different kind of people in the past, of how they've built their wealth, it always comes down to leverage. Whether you're Robert Kiyosaki using the bank's money to build your real estate empire, or you're Bill Gates, you're leveraging, maybe investors or VCs, venture capitalists, their money to build your company. Or if you're on Shark Tank and you're pitching to Mark Cuban to, you have this great idea and you need funding, it all comes down to leverage. And that's really what got me thinking, okay, well, in my own personal life, what could I do to build my wealth, right? I currently have a mortgage, I have a rental property, and I'm leveraging the bank's money in that way. But what I was thinking is what if I could use my existing mortgage and leverage the equity that I have in my mortgage and then take out a home equity loan. So that's where I kind of got started thinking about this. Okay, so on my mortgage, my current homestead where I live, I have equity into my home, and what I was thinking is I could take a home equity loan at a fixed rate, not an adjustable rate, a fixed rate, and borrow against the equity that I already have currently in my home, and then take that money from my mortgage and then invest it into the stock market, and then investing on leverage. Now, before you click away from the video and think, okay, well, that's just absolutely crazy, why would you ever do that? Now, I want to be very transparent and say, you know what, up until a couple of months ago, that was my perception. I was very against debt. I really, especially consumer debt. Consumer debt, I'm completely against, but that really got me thinking, okay, well, these other great investors, these great innovators, whether, be Bill Gates, Ben Malla, Robert Kiyosaki, they've always used leverage to get somewhere in life. Now, I just look at the story of Ben Malla. I mean, Ben Malla came from nothing. And I thought to myself, well, how did he do it? How did he come from nothing to now he's a multimillionaire? How did he do it? And it really boils down to, yes, his network, yes, he was a hard worker, but it comes down to leverage. And for him, it worked out very, very well. Now, with this crisis going on, we can kind of reevaluate that and see, okay, is it still going well for him? But really, that's beside the fact. So focusing on that, when I thought about it in my own situation, these numbers here are very generic. These are not the actual numbers of my home, but it just kind of made me start thinking about, well, what could this look like if I were to leverage the equity in my home so that I can pull up, use the bank's money to grow my portfolio as an example? What would that look like? Okay, so if I were to use the home equity in my home, say for example, $50,000 worth, and if I were to get a home equity loan or a second lien on a second mortgage, what would that look like? Currently, with the rates so low, I would just get around a 3.5% for 15 years. Now, this is not adjustable. This is fixed. The bank can't say, as long as I'm making the payments, the bank can't come say, okay, all right, your mortgage is callable, you have to pay in full. No, it's a fixed rate. And the monthly mortgage payment or second lien or on this loan would be $357 every single month. Now it got me thinking, okay, $50,000, I'm not going to be able to buy an island with that, but it's not crazy. It's manageable. And what I started thinking was, okay, well, I know people that spend more than that every single month just in a car payment, right? If you look at the average car payment here in the United States, for a new car, it's over $550 for just a new car. And this is a depreciating asset. If you're talking about a used car, it's just under $400. So that really got me thinking, okay, well, if people are spending this much money, more than what I'm even thinking about, to purchase an appreciation asset class, in the stock market, it is an appreciation asset class, whereas people are spending more than that on a depreciating asset in a vehicle. So it really got me thinking, okay, well, does this make sense? And so what I started to do was I started looking at the numbers, and the numbers are so interesting that, the more that I started digging, the more that I was like, oh, wow, this actually could work. Now, once again, what I'm talking about, this is based off of today's rates. Now, if I were to do this 6 months ago, a year ago, I don't think the numbers would look as attractive, because now the investments that I'm looking at are yielding very high and interest rates are very low. So we're in a very interesting environment that we haven't been in for a long time. So let's go ahead and let's take a look at some of the numbers. Okay, so the investment that I'm looking at here is the ETF from Invesco, the SPHD. The SPHD is a monthly dividend payer. That means you're getting paid a dividend every single month and not every single quarter. It's a qualified dividend, so you're getting paid at the most favorable tax rate, okay? And so the interesting thing here is this ETF has a decent track record of dividend growth, right? So between 6 and 10%. It hasn't been around for all that long, but it's still a high quality dividend growth ETF. If you look on the yield on cost, and this is what I mean by the numbers, right? So, 6 months ago, a year ago, it was yielding just over 4%, which is still not bad. But here, if we look just last month, a couple of weeks ago, it was yielding a little over 7%. All right. And so it's important, I think, to understand, okay, what is SPHD? Like what are you getting with that? So if you head over to ETF.com and you put in SPHD, and you scroll down, you can take a look and see, okay, what exactly are you getting with this investment vehicle, with this ETF? So SPHD, what it does is it takes a look at the top 75 highest yielding dividend securities of the S&P 500, and it takes the 50 lowest volatile names. So the low volatility, you're going to have less fluctuation in price, okay? And so if you scroll down and you take a look at, okay, the essential pieces of information, right, the expense ratio, so you're going to have to pay a small expense ratio for this ETF. Now, this is much higher than a fund like from Vanguard or index fund that tracks the S&P 500. So you're paying a little bit of a higher fee. So that's something to factor in and understand. Okay, but you're also getting a monthly dividend. So that's factored into the fees that are associated with this ETF. Now, the important thing that I want to highlight here is you want to take a look and see the individual companies that you're getting exposure to. Here really quick, so the number of holdings, you have 51 holdings in this ETF. Of the top 10, it's weighted at right around 28%. You're getting companies like Altria Group, Philip Morris, AT&T, Dominion Energy, IBM, Progressive, General Mills. And this is how the ETF is set up. So you can see, okay, there's fair diversification throughout the 51 holdings here in this ETF, and you can take a look and see, okay, by picking this ETF, what kind of companies am I being invested in? So you got 3M, for example, a great dividend king, been paying a dividend for over 50 years. You got companies like Wells Fargo and others, right? So that's how you can see, okay, what you're getting with this investment, and you can kind of assess, all right, well, what is kind of my risk factor when investing? Okay, so let's go ahead and let's put all the numbers together. All right, so we're taking the $50,000 from the home equity loan at 15 years with a monthly payment of $357 every single month. Now let's take a look at the dividend calculator here. Okay, so this is from Investopedia, right? Investopedia Dividend Investment Calculator. And if you go down here, the initial investment of $50,000, we're not going to have any additional investment after this. It's just going to be one lump sum. We're going to have an assumed dividend growth rate of 8%. Now, once again, this is going back from what we saw in Seeking Alpha. It was right around between 6 and 10%. So I took a number here in the middle and went with an 8% dividend growth rate. Now, with an assumed dividend yield, this is what we were talking about with that yield on cost. It was yielding all the way up to above 7%. When I was looking at this, it was yielding right around 6.5%. So we're going to plug in 6.5%. The next thing here is the reinvestment. So I want to take the first scenario where we're not reinvesting the dividend. The dividend is being paid out, and I want to use this simply because I want to see kind of the scenario, what it would look like if we're going to pay the mortgage payment or the home equity loan payment with the dividend. So that's what's really interesting. We're going to do it with and without, so two scenarios. And with an assumed inflation rate of 2.2%, this may go up with all the stimulus, but who knows, and an assumed growth rate of 8%. This is pretty conservative considering the investments that we have in there. Okay, so if we take this scenario and we plug it in, this is what we're going to be getting. So in the second year, the first year, you're going to have $53,000 in the portfolio value, but in the second year, you're going to have just over $3,500 in annual dividends. Okay, in the third year, you're going to have $3,790 in annual dividends based off of the assumptions above, right? In the fourth year, you're going to have just over $4,000 in annual dividends. Okay, so this is really, really important. So remember this. Now, one thing to also highlight is take a look at this. Take a look at the end of the portfolio value. We're already at $68,000. Now, this is assuming all of the assumptions above, right? No one has a crystal ball. No one can tell if this is going to, we're going to go into a depression or if we're going to see the greatest recovery in the history of our country or the world, whatever. So no one really knows. All right, so these are the assumptions that we talked about. These are the numbers, okay? Now, let's take a look at the dividend calculator. If we go over to Bankrate and we type in the $50,000 price, we put in the 15-year. This was actually what they quoted me on the phone. The loan here from Amplify Credit Union, this is a credit union down here in Austin, Texas. I actually gave them a call, and the price or the interest rate that they quoted for excellent credit was 3.45%. Really interesting. So $356 every single month. Now, let's take a look at the amortization schedule of this loan, okay? And so if we pull it down here, what that breakup is going to look like, you're going to be paying $143 in interest in your first payment. And in the, if we actually take this and we do it from the very beginning of the year, it just makes the numbers a little bit cleaner. If we do that, in the first year, you're going to pay $3,916 as the total payment. Now, the interest, you're going to pay just over $1,500. Okay, now what I was thinking with those scenarios that I was talking about earlier is this, right? So you have your annual dividends. This is the dividend calculator, remember. If I'm going back and forth here. I hope that everybody can follow this. But here you have, this is what you're going to be paying to the bank, $3,916. That's with the principal and the interest. Now, if you go over here, it's going to be in your fourth year. If you don't reinvest the dividends, you use the dividends to pay off the loan, for example, after your fourth year, you're going to be able to pay for the entire payment of that mortgage or of that loan. Now, that's really interesting. 4 years. In just 4 years, you're going to be able to cover the entire payment. Okay? And so if we fast forward to the end of the loan, After the 15 years, so in the beginning of the 16th year, you're going to be getting over $10,000 in annual dividends if you don't reinvest, and you'll have over $170,000 in your portfolio after the 15 years. That is incredible. Now, let's take a look back at the mortgage calculator and see what your fees would be. Now, if you go look at, okay, yeah, we're going to be paying principal and we're going to be paying interest, but after 15 years, let's see if I can get the cursor here. After 15 years, you're going to be paying just over $14,000 in interest. $14,000, okay? And if you have this for 15 years, you're going to be getting over $10,000 in annual dividend income, and your portfolio will be valued at $170,000. I'm going to let that sink in there for just a second, right? Now, obviously, there's always risk associated with any investment. But if we take a look at, once again, this is an appreciating asset. This is not a car payment. This is not depreciating. This is appreciating. And that's what makes this so interesting. Okay, now let's take a look. Let's say, for example, you could cover the mortgage payment, the $356. Remember the $356, the mortgage payment? Let's see if you could, okay, well, let's say you could cover that and we want to reinvest the dividends for those 15 years. What would that look like after the 15 years? If you reinvested the dividends, you would have just under $26,000 in annual cash flow. And your portfolio value would be over $430,000 from an initial loan of $50,000, and out of pocket, you're paying $14,000 in interest to the bank. That is really the power of leverage, right? Now, every investment comes with risk. You could buy a rental property, a house on leverage, and your house could burn down. Your tenants could put holes in the wall. They could, there's so many different risks and so many things that could come into place. And it really got me thinking, well, that's amazing, right? Like you're always going to have risk. And when I look at these other people, like for example, Ben Mallet, who went from rags to riches, how did he do it? He did it through leverage. Now, I'm not to say that this is the right approach for everyone, but the numbers don't lie. And now no one has a crystal ball, no one can see into the future, but the numbers don't lie. If things, and this is really the tricky part, is to say, okay, that this is going to continue where no one knows what's going to happen, right? I personally believe that we're going to come out of this time that we're, this hardship that the world is facing. And, it's not something to kind of shrug off. It is a huge impact to the global economy, not only the economy, but to our lives, our livelihood, our families, and everything. But what I'm saying is leverage, it's all about the numbers. And if the numbers make sense, it actually could turn out in your favor. And so that's kind of the thought process that I had here, is that with this monthly payment of $356, I'm paying less than I would for a car payment, right? And the upside, if the numbers pan out the way that I'm seeing here, it really makes this an attractive investing opportunity. Now, I'd be curious to hear what your thoughts are, right? Once again, in terms of full disclosure, I'm not currently doing this. I'm not currently investing into SPHD. I've not currently pulled out a loan. This is something that I'm keeping a close eye on. I'm considering, but I'd be curious, what are your thoughts? Have you ever done something like this before? Is this something that you've ever considered? Thank you so much, everybody, for watching. If you liked the video, hit the like button. If you didn't like the video, you're totally against leverage, let me know in the comment section below. I'd love to hear your thoughts. If you're interested in dividend growth investing for dividend cash flow, hit that subscribe button, and I will catch everybody in the next video.